Most beginner investors think the market only has two phases: it goes up or it crashes. But the reality is much more complicated. There are investment cycles happening all the time, and many of them quietly shape when people make money and when they lose it. The strange part is that most beginners only hear about these cycles after they've already been caught in them. So in this video, we're going to break down several investment cycles almost no one talks about, and how understanding them can help you make much smarter decisions as a beginner investor. The hype cycle. The first cycle is the hype cycle. This is the pattern where an idea slowly gains attention, then suddenly explodes with excitement. At first, only a small group of people know about the opportunity. Early investors quietly buy in. Then the media starts talking about it. Social media amplifies it. Everyone begins sharing success stories. And suddenly, it feels like everyone is getting rich except you. That's usually when beginners rush in. But historically, hype often peaks right before prices stop rising. A good example of this kind of pattern appeared during the dot-com bubble in the late 1990s. Many companies with little revenue saw massive valuations simply because people believed the internet would change everything. And while the internet did transform the world, many investors still lost money because they entered during peak excitement instead of early growth. The lesson here is simple. If an opportunity feels like it suddenly appeared everywhere overnight, the cycle may already be near its peak. The attention cycle. Another cycle beginners rarely think about is the attention cycle. Markets often move not because something is new, but because people are paying attention again. A sector can stay ignored for years. During that time, prices move slowly and quietly. But eventually attention returns. News headlines increase. Investors start talking about it again. Prices begin rising faster. The interesting part is that the biggest gains often happen before something becomes popular. By the time everyone is discussing it, much of the growth has already happened. Great investors spend a lot of time looking at areas that currently receive very little attention, because attention itself can drive investment cycles. The patience cycle. This next cycle is one of the most important for beginners, the patience cycle. When people first start investing, they are usually very patient. They expect to invest for years. But after a few months of slow growth, that patience disappears. Investors start checking their accounts constantly. They switch strategies. They chase faster returns. Ironically, markets tend to reward the people who simply stay consistent through the slow periods. Legendary investor Warren Buffett often talks about how investing success comes from letting compounding work over long periods of time. But compounding doesn't feel exciting. It feels slow until many years have passed. The patience cycle explains why many beginners quit strategies right before they start working. The fear cycle. Another powerful cycle is the fear cycle. When markets drop, news headlines become extremely negative. People begin to worry about losing everything. Investors panic. Many sell their investments to stop the pain. But historically, fear often peaks near market bottoms. A good example happened during the 2008 financial crisis. At the time, global markets looked incredibly uncertain. Many investors sold during the worst moments. But the years that followed produced one of the longest market recoveries in history. The fear cycle shows why emotional decisions can be so dangerous for investors. How beginners can use these cycles. Understanding these cycles can help beginner investors avoid some of the most common mistakes. When hype suddenly appears everywhere, slow down and research carefully. When markets feel scary, remember that fear is often part of the cycle. When investing feels boring, that may actually mean your strategy is working exactly as intended. And most importantly, remember that cycles repeat. They may look slightly different each time, but the underlying patterns of human behavior and emotion rarely change. The biggest secret about investing cycles is that they are usually psychological, not just financial. Hype. Attention. Fear. Boredom. Patience. These emotional patterns influence millions of investors around the world. And the people who understand these cycles often make better decisions simply because they expect them. So if you're a beginner investor, one of the most powerful advantages you can develop isn't predicting the future. It's recognizing the cycle you're currently in and staying calm while everyone else reacts emotionally. Because in investing, understanding behavior is often just as important as understanding numbers.